Good morning, everybody. We just are 9 o'clock, so I think we can get started. I hope you're all staying warm and healthy and safe. And yeah, welcome to our presentation this morning from a very cold Johannesburg. Yes, so today we're going to cover a topic that I did discuss that I did do a presentation on last year as well, and that is on IFRS 16. We had a lot of clients that we've done audits for the December 19 year ends or February 2020 year ends, where we get into the clients and they haven't really taken IFRS 16 into account yet. You'll see later on, it has been effective since 1 January 2019. So it should have been taken into account from there. But what we're realizing is that a lot of people and clients aren't quite sure what to do and have carried on the December 2019 or the Feb 2020 year end as they have been or as they were used to under the previous leases standard being IAS 17. So we just thought that it would be a good idea that we run through this presentation again and just recap what the requirements of IFRS 16 are and what has changed with regards to lease accounting and hopefully just just inform you of what the requirements are in the need to account for leases now going forward. I'm just going to start the beginning of the presentation just really dealing with what a bit of the definitions and what is a lease in terms of IFRS 16 and what it means. And then I'm going to move on to a bit of the actual measurements and how do we account for the lease and calculating the different components. And then I'm going to just end with a bit of a case study at the end of the presentation, just to give you a brief, very simple example of the requirements in accounting for a lease and IFRS 16. Please just bear in mind that as we go through this presentation, that this is definitely from a lessee point of view. So this presentation is focusing on you as a lessee and not as a lessor. Lessor accounting has pretty much remained unchanged. And still distinguishes and differentiates between an operating lease and a finance lease as we were accustomed to in IAS 17. So this is really from a lessee point of view. So just bear that in mind as we go through the presentation. So yes, let's get started. And thank you very much again for joining us. If there are, just before we do get started, sorry, if there are any questions, please raise a question in the Q&A section. What we'll do is we'll get all those questions afterwards, and I'll then email a response to whoever the person asking the question is. Because we probably might not have time at the end of the presentation to answer the questions, but please feel free to raise your questions anyway, and I will respond to those via email. So just looking at some of the definitions. Firstly, when does a contract contain a lease? So very importantly, a lease, a contract is a lease where it conveys the right to control a specific asset, being an identified asset, for a period of time in exchange for a consideration. Again, the principle of control is very important here. Again, we see that more and more now in the different IFRS standards. And once again, we saw it in this one. So it's the right to control an identified asset in exchange for consideration. You're going to pay for it for a period of time. So where you as the customer control that asset and has the right to control that asset, it's a lease. But where the supplier has the control, it's a service. So that is clearly that distinguishment there. You as the lessee has to have the right to control that asset in order for there to be an asset, for there to be a lease. So you as the customer would control that asset if you have both. So firstly, you have the right to direct the use of that asset. And secondly, that you will receive substantially all the economic benefits that are associated with that asset. So if both of those are present in the agreement, then you as the customer or the lessee would then have the right to control that asset. So what do we mean by an identified asset? The agreement has to identify the assets in the contract either explicitly or implicitly. It can't just be a generic, some office block somewhere, or just a office or whatever that might be. It has to explicitly either refer to the asset or implicitly be a specific model of an asset for the assets to be identified. And then secondly, what's also important to consider is whether the supplier of that asset has a substantive right to substitute that asset or not throughout the lease period. This is very common with, for example, where we lease a photocopy machine or something, where often in the contract it would say that the supplier of that has the right to substitute that at any time and swap it out for another asset. So if the supplier has the practical ability, so the supplier of that asset has the practical ability to substitute the asset, and you as the lessee or the customer can't stop that, then there would be a substantive right by the supplier. And then if there is a substantive right for the supplier of that asset to substitute that asset, then the asset is not identified and you then do not have the lease. What's important to note is the substantive right is something that we need to determine at the inception of the contract, not any other time. So it's an assessment that gets made upfront at the beginning of the contract that gets entered into. Economic benefits. What is meant by economic benefits? So, like I said, a part of the right to control an asset is that you as the customer need to have the right to substantially all the economic benefits that come from the use of that asset over the period of time. So again, for example, if you're leasing a motor vehicle, you have substantially all the economic benefits if you can use that motor vehicle for typically what we'd see as a useful life for a motor vehicle, and you can use that vehicle to in whichever way you seem fit over that period in order to deliver your service. So what do we mean by benefits? So there's the exclusive use of that asset. Also, if you have the ability to sublease the assets, and then one that's not very common, but the primary or any byproduct cash flows from the use of that asset that might flow. So that's pretty much in brief what an asset is. And when a contract that you have entered into does contain a lease or not. So just to recap, very, very importantly, that you control that asset, and that the asset that you have got the right to use is specifically an identifiable asset within that contract. If those are present, then you typically would have a lease, and you would have to then account for those leases as the lessee under IFRS 16. And what we're going to go to now is just the measurement, really, and that's where we're going to spend most of our time before we get to the example. It's just the measurements of the different elements within IFRS 16 and accounting for a lease as a lessee. It all starts with the lease liability. So that's what the first determining factor is that we need to do. So we need to determine what the lease liability is. So the lease liability, in simple terms, I will go into each aspect of the calculation in more detail now, but simply what it is, it's the lease payments that you're going to make during the lease term, and you multiply that by a discount rate. I will go through, like I said, what the lease payments are, what the lease term is, and then what the discount rate is. So each of those elements is something specific that needs to be worked out and calculated at the inception of a lease, in order to determine what the lease liability would be. Briefly, the discount rate. So the standard defines the discount rate as being twofold. Either it's if it's readily available or readily determinable, the rate that's implicit in the lease. That's not very common or very popular, so I haven't really seen that much at all. So, but otherwise, if there is no rate implicit in the lease, then it's the lessee's incremental borrowing rate. So what that means is the rate that needs to be used in order to discount your lease liability is the rate at which you as the lessee could secure funding in order to buy a similar asset under similar terms. So what rate would your finance provider give you to buy a similar asset for a repayment over a similar period as the lease? So that would be the rate your incremental borrowing rate that you would use then to discount that lease liability. The next aspect is, what are your lease payments? So the easy part is the lease payments are your fixed payments that typically it would say lease is payable annually in advance or monthly or quarterly or whatever it might be, and you pay X amount per month or per year or whatever it is. Secondly, what needs to be taken into account are and this is quite important for the distinguishment of variable payments. So variable payments that are dependent on an index or a rate will be taken into account. So if your lease, often your lease would say it would go up by inflation or 8% annually or whatever it might be, then you would take into account those variable payments in determining your lease payments. However, if you're often a lease would, especially in the retail industry or in the manufacturing industry or whatever it might be, a lease would say that your rental is a fixed amount, but also you would pay a percentage of sales or volume output from the asset or unit output or whatever it might be. Those are not included. You will not include those in as a lease payment in determining your lease liability. And then lastly, any optional payments that there are within the lease. So only include these if you are reasonably certain that those costs will be incurred. If you don't know at the inception, and again, this is at the inception of the lease, if you don't know whether or not you're going to include, if you're going to incur those costs, then you would not include them. But if you're reasonably certain that you're going to, then you need to include them in your lease payments. And that's any residual value guarantees that leases often have, or a purchase option at the end of the lease that you would pay a sum of money in order to get that lease, to get ownership of that asset at the end of the lease term. Then you would include those, like I said, only if you are reasonably certain that you will incur those costs. Then the lease term, this does get quite involved. So the easy part is the non-cancelable lease period. Most leases would say, yes, okay, you can lease this asset for 5 years, 3 years, this property for 10 years, this vehicle for 5 years, whatever it might be. So that's pretty easy to determine in most leases. However, what needs to be taken into account as well is any possibility of extension where the lessee is reasonably certain that to exercise that option. So where most leases would say, okay, it's a 3-year lease and you can extend that for a further 2 years, or it's a 5-year lease and you can extend that for another 5 years, or whatever it is. That extension period also needs to be taken into account in your lease as part of your lease term, if you're reasonably certain that you're going to exercise that option at the end of the lease. I've had lots of questions of saying, okay, but no, we're not going to, because they want a shorter lease term in the calculation, or no, I don't think we're going to, or whatever it might be. But what we do need, there are indicators that we do need to take into account within the standard of whether or not it's true, and what the likelihood of this extension is going to be or not. So things to consider is the levels of rentals in a secondary period compared to the market. So if your rentals are going to remain pretty consistent in the extension period, but the market is double or quite a lot more, then you would argue, why would you want to end your lease and you not extend? Or if there's contingency payments that you need to make at the end of the lease, again, if those are significant, the question should be asked. To avoid those payments, you more likely will extend. Again, renewal purchase options, cost of terminating the lease or signing a new lease. The nature of the asset that you're leasing, often assets are very specific, and you then it's going to be tough to argue that you're not reasonably certain that you are not going to extend that lease if it is a specific asset that you are using or leasing. And then also location, maybe you're in a prime location and there's not an availability of there's not a suitable alternative for you to be able to move to if it's a premises or a property. So although you might have spent a lot of money on leasehold improvements to get the premises or the property or whatever it might be to a condition that is satisfied, that is suitable for you to use. So all those factors need to be taken into consideration in determining whether or not there's reasonable certainty that you would exercise that extension option. Plus, then you would also then include, lastly, any period covered by an option to terminate, where it is reasonably certain that the lessee will not terminate the lease. So often a lease would say that you can terminate within 3 months before the end of the lease or whatever it might be, you would take into account that those 3 months if you know also again reasonably certain that you're not going to terminate that lease. So it's very important to take those factors into account. So in determining whether or not to include that extension period within determining your lease term. Lastly, your assets. So now the starting point for the asset, like I said, is always the lease liability. So we've gone through what the lease term is, what the lease payments are, what your incremental borrowing rate is. So you now have calculated your lease liability. So the start of your asset is always your lease liability. Then you would also then add to your assets any lease payments that you made at the commencement date, and then less any lease incentives you might receive for entering into that lease. So for example, if you pay for your first month's rental in advance, you won't take that into account in calculating your lease liability because you've already paid it, so you don't have a liability, but you would include that initial payments into the cost of your right of use asset. And then any direct costs that you might have incurred, you would also include in your cost of your assets, and then any your normal provision that you might have, your costs that you might have to incur if you need to dismantle or remove the underlying asset. That's the typical dilapidation provisions that we're all used to with regards to certain sites or whatever it might be. So if you're going to incur the cost that you need to incur in dismantling or removing the specific asset you might be leasing, you would include that cost or that estimation of that cost to the cost of the assets as well. So what do we do now? So now we've calculated our lease liability, we've calculated our lease assets. What do we do subsequently to this? So well, now we've got them, we've accounted for them. How do we move forward? So the right of use asset is similar to any other non-current asset. You would depreciate that through P&L and you would assess it for impairment. So like you used to with your PPE or whatever it might be, you would simply depreciate that. And the depreciation and the period of depreciation I'll go through now because it does depend on the nature of the asset, and then on the conditions attached to that asset, but I'll go through that now, but it's simply depreciate the assets over a period of time, and you would then assess it for impairments annually. Your lease liability is similar to any other financial liabilities. It's not difficult. You would unwind, you would have discounts unwinding through P&L that you would recognize, which is the interest, and then you would also then reassess, and then you would also then decrease your liability by any payments that you make towards the lease, and obviously then you would reassess the lease liability if there's any changes in the lease term that might have changed from initial assessment, and then your changes in the cash flows due to those changes in the index that I said are included as variable payments. You would also then amend your lease liability once you know what that index or inflation number is or whatever it might be. Once you know what that actual number is, you would then reassess your lease liability. And then you would take into account any lease modifications. So often during a lease term, maybe the term something specifically changes within the lease, and there is lease modification, and you would have to just account for those as and when they occur. There are two things that two exemptions that we do have that are allowed within IFRS 16 in recognizing these rights of use assets. The first one is short-term leases. So any lease that is less than 12 months, what the standard says is we could typically treat those as we have been under IAS 17 and expense that rental or that lease charge as and when we incur it. Please bear in mind that I've often been asked the question of, okay, now we've got the lease term, can we not just have a consecutive short-term lease for a building, for example, and always just recognize the expense? What is important to remember, though, is what I mentioned in the beginning with determining the lease term is the likelihood of you renewing your lease firstly, and also and using that asset beyond that term. So that is important to take into account as well. And then also low value assets. So any assets, then this is a by asset thing, not for the lease as a whole, but if you, and the standard, the basis of conclusion refers to a $5,000 threshold for which is classified as a low value asset. So this would be per asset, like I said, and not for the lease. So you might lease 10 laptops, but each laptop is less than $5,000. You would then be able to apply this exemption and say that those are low value assets, and you would then simply expense those as we are used to. The effective date of the standard is 1 January 2019, like I said. So it has been around for a while now. We are used to it. And it should have, and effectively you would have then been accounting for this from the beginning of last year. So your year ends December 19, Feb 2020, June 2020, that's coming up now. So yeah, so please feel free, if you haven't taken these into account yet, you've still been expensing your lease payments, you haven't done the calculations or the assessments on the leases yet, please feel free to get hold of us should you need to in assisting in determining those. Transition, there are two transitional options. The one is a fully retrospective, so that you would restate all the comparators as if IFRS 16 is always applied, and you would do the line by line comparison disclosure. You would amend your comparatives, 3-year balance sheets, all those lovely things. Then, which I found recently is the most common one, is the option 2, which is the cumulative catch-up. So that would firstly would be you would leave your last year's figures reported as they were, and then you would then adjust your opening rate. So you would calculate the impact of IFRS 16 on your leases that you currently have, and you would draw a line at your year end, at the beginning of your year end, and you would then see what your lease liability would have been and your leased assets, and then any difference you would just adjust to opening retained earnings. The amount of work that goes in is the same, I think, because you still need to do the calculation. It's just that you would leave your disclosures a bit easier, because you would leave last year's as it was, and you would fix any effect of this in your opening retained earnings. So a quick little example and case study to go through. It's quite a very simple one. So just to illustrate what needs to be done. So firstly, a lessee A enters into a 5-year lease, which is typical for a building. Lessee A incurs an initial cost of 30,000 Rand, 20,000 Rand relates to the payment to a former tenant occupying the property, and the remaining 10,000 Rand is to the estate agent for negotiating the lease and arranging the lease. The contract is set for a minimum lease term of 5 years with an option to extend for a further 5 years. So we're going to assume, though, however, just for practical purposes, that they're not likely to extend. The lease payments are as follows. So the first 5 years is 50,000 Rand up in advance annually. So on initial recognition, step 1, like I said, we need to determine the lease liability at the commencement date and discounted that at a discount rate. We're going to assume that the discount rate in this case is 5%. So there it is, quite simply. Remember, we don't take lease year 1 into account because we've already paid for that up front. You'll see that coming into the calculation of the asset. And then you've got 4 more payments of 50,000 Rand is going to come over the next 4 years of the lease. Over the term of the lease, you discount that rate at the 5%, and you get a present value, and you then determine and you calculate your lease liability. There it is, the 177,300. Quite simple, a normal amortization schedule discounting those payments over at the various stages of the lease. You're determining your lease right of use assets. Again, like I said in the beginning, we always start with our lease liability. So it's 177,000 that we got to. You would add your first lease payment of 50,000 Rand. Again, your initial direct costs we can include. Those are the 30,000 Rand. And assuming we receive a lease incentive of 5,000 Rand, we would then take that into account as well, getting us to a right of use assets of 252,000. The journal entries, just for those who like those, your right of use assets, you would debit the right of use asset, credit your liability, and then simply debit bank with the initial cost that you've paid and your initial rental, and you would debit bank with your lease incentive. And that's your journal how you would initially recognize any lease as a lessee under IFRS 16. Subsequent measurements for the right-of-use asset. This is where I spoke about the different depreciation periods earlier. So if the right-of-use asset is carried on the cost model, you would simply count for that like you would under normal PPE is the cost less any accumulated depreciation and any accumulated impairment losses. Depreciation from the commencement date to the end of the useful life. You would depreciate the right-of-use assets over the useful life of the asset as you determine it to be, if ownership of the underlying asset transfers to you at the end of the lease, or if there's the cost of the right-of-use asset reflects that the lessee will exercise, that you as a lessee will exercise the purchase option. So if you included that purchase option in the initial lease payments, because you were expecting to pay that at the end of the lease and take ownership of that asset, then you would depreciate that right-of-use asset over what you determine the useful life of that asset to be. If not, you would then depreciate the lease over the lease term. So if you're not going to take ownership and it's just for a certain period of time and the lessor will take the asset back, or you would vacate the property or whatever it might be, then you would just depreciate that right-of-use asset over the lease term. If your right-of-use asset is accounted for at the fair value model, and that's typically for investment property, then what the standard says is if you have a policy of accounting for investment property at fair value, then you must also measure your right-of-use assets that meets the definition of investment property at fair value as well. If the right asset relates to PPE that you account for under the revaluation model, then there is an option that you may elect to revalue that right-of-use asset as well, if it relates to that particular class. So right-of-use assets at the fair value in accordance to the fair value model, if it's investment property, it must be remeasured as well at fair value. If it's not, and if it's PPE and you calculate those at the revaluation model, then you may elect to also revalue that right-of-use asset. The lease liability, quite simple, the carrying amount will change. You would increase to reflect the lease, the interest on the lease that you're unwinding, and then you would reduce it to reflect the lease payments that you made. And then you may have any remeasurements, like I said, which specific are any reassessments, be it the lease term or the changes in your variable payments due to that index that you've now determined what it is. And then you would, there are certain lease modifications that might occur as well that you would have to take into account as well. So yes, so that was a very simple example that I just went through, just to explain kind of what the requirements are for accounting for the leases and recognizing right-of-use assets and that lease liability. So like I said at the beginning, please, if you are unsure, or if you've just been accounting for leases consistently as you always have under IAS 17, please feel free to give us a shout and we could then assist in possibly doing those calculations. So if you want clarity on something, I know half an hour is a short time to go through it all. And to get a full understanding. So if there are questions that have come through, I will receive those and I will attend to those straight afterwards. So thank you for listening and thank you for taking part in this webinar this morning. And I hope it was valuable and hopefully we can see you on the next one. Right. Thanks very much, everybody.